Let's get to today's strategy session. The market rebound losing some steam. You can see it, the red across your screen right now following Monday's AI-driven sell-off. So is now the time to buy the tech dip, or is more volatility ahead? Joining us now, we want to bring in Abby Yoder. She's JPMorgan's private bank's U.S. equity strategist. Abby, how should we be thinking about the last couple of days?
Well, I think the last couple of days in isolation have obviously been very volatile. We've been thinking that, the last year was really rare, right? Like we had two 8% drawbacks in the S&P 500. That's essentially like no volatility to a certain extent. So seeing this happen, we couldn't have guessed the reason why. Like we didn't expect it to be this, but we were expecting, volatility and a reset in valuations. That's something that's somewhat healthy. So seeing this broadening out and seeing this correction is relatively healthy in our view. I think to your question on like, does this downtrend continue? I don't think so. Like our year-end target remains 6,400. I think we're in the third year of this AI revolution. We're going to be, seeing fits and starts in terms of who's the winners and who's the losers.
Do you think it's some of those companies that have led, though, that narrative that are going to lead the pullback then, too? Because, I mean, realistically, even coming into the DeepSeek news, Apple was already down in its own correction of about 10%. NVIDIA was already slipping as well. And so the rest of the market really just kind of catching up after that DeepSeek ball dropped as well.
Yeah, well, I think, look, people sell what they own. And that was, all the narrative the past couple of years has been the concentration risk and really around valuations. So yes, I think when you're thinking about, and particularly given the catalyst that was, this week in terms of the AI narrative, that's really like, are we at risk? Does that narrative change? Like what's going on in the next couple of years? I think that's, to that point, that's why they are leading to the downside. But you're seeing the rest of the market do fine, right? Like equal weight was flat on Monday when the market cap weighted index was down 1.5% and 70% of companies were up.
What does that tell us then just about the staying power maybe of this rebound and the signs of it that we have seen, the fact that there is so much optimism still at play right now?
Well, I think the read through to that, at least for me when I'm thinking about it, is okay, you see the rest of the 493, let's call it, doing well. I think what is going on is, okay, what's happened essentially is we have AI that's just as effective at a lower cost. So if I'm a company in any other industry and I'm thinking about, okay, there was this barrier in terms of cost previously, and now that's been lowered, and now I can implement not only more use cases, but at a lower cost. I think that's the read through, right? That means productivity enhancements, that means lower costs, that means better margin profiles.
What is the timeline that investors should be grading companies against when it comes to the capital expenditures that we're going to be hearing about over the course of this earnings season?
Well, look, we're going to get some insight this week that I think is very important. And I think throughout the year, right, like there essentially annual expectations for CapEx are already, out there. Are we going to see a pullback in that? Probably not. That's not our view. So thinking about the out years though, right, when you're thinking about growth investments, you want to think about the out years. You want to think 26, 27. So thinking about that, I think will be very important. And how that, in the mix of that spend, because even if that spend is the same, the beneficiaries of it might be very different.
And Abby, since we do have the Fed decision coming out later on this afternoon, obviously very much market pricing in the fact that we're not going to get any movement on rates. So clearly the focus will then be on the rhetoric and some of the statement and commentary that we're getting from Powell. How are you thinking about this risk that we could get more hawkish commentary and maybe how that will play out in the market?
Well, our view is that we don't get that hawkish commentary. I think we're still seeing signs of the labor market weakening, particularly as it relates to wage growth, right? Like that's the one thing we're really paying attention to. Also, shelter inflation plays a component into that. Obviously, it's a risk, but I think the market is really debating, like, it's kind of a toss-up. Is it 0 this year? Is it 4 this year? Like, I don't think there's really high conviction. And I think the biggest point is that we don't think we're going to get messaging that they're about to hike, right? Like, that's the important thing. Like, maybe there are less cuts than previously expected, but it's not a hiking scenario, right? Because at the margin, again, you're still seeing that labor market weakening.
What happens though if the Fed doesn't cut it? Will the market be able to sustain some of this momentum?
I think so. I mean, you've seen, 8 cuts priced out over the course of last year, and the market was up 25%. Right? Like, it is able to sustain it. I think what's been so shocking to everyone is the fact that GDP growth, it doesn't seem like the U.S. economy is particularly interest rate sensitive, right? There are parts of it that are housing, but and some cyclical parts, but for the most part, it's really just been resilience.
Abby Yoder of JPMorgan Private Bank. Thanks so much for joining us in studio.
Thank you.
Good to see you.